Imagine waking up in the morning knowing that you'll earn over $30,000 that month regardless of how you choose to spend your time. Well, that's exactly what life is like for Australian investor Peter Thornhill, who famously receives over $400,000 per year in dividend income from his portfolio. The man, the myth, the legend. Who exactly is Peter Thornhill? Peter worked in the financial services industry in both the UK and then back in Australia before retiring from his corporate career to educate others about investing through his keynote presentations and his successful personal finance book called Motivated Money. Peter, along with his dividend growth focused investment style, has become a fan favourite in the Australian financial independence community, featuring on a number of blogs, podcasts and forum discussions. His investing strategy. In a nutshell, the core of Peter's strategy is on investing for a growing income stream whilst ignoring the movements of the stock market prices. His strategy focuses mainly on buying a basket of diversified dividend-paying shares and holding them forever. The principles of the Thornhill method. Spend less than you earn. No rocket science here. One of the most important factors in building wealth is savings rate. Enough said. Borrow less than you can afford. Most people go to buy their first home and borrow as much money as the bank will possibly allow them to, then borrow more to buy furniture and a car, etc. But Peter suggests that you should consider buying a moderately priced home or renting to allow you to continue to focus on building your share portfolio. Build a diversified portfolio of dividend-paying shares. Why shares for income? The stock market has two primary functions. The first is to enable companies to raise capital, and the second is to provide investors with an effective mechanism for exchanging ownership of their shareholdings in these companies. However, the liquidity provided by the market is often to its downfall, because the daily volatility of the market provides for much distraction and speculation. Peter believes that these daily movements in prices are all noise, and we should not waste our time on this madness. We should simply ignore it and focus on the rising income and long-term growth that the stock market can generate for us. Why businesses pay dividends. When a company makes a profit, its directors may choose to pay a portion of the company's profits to shareholders. This is called a dividend. The company will also retain a portion of the profits to grow the business by reinvesting into expansion, for example by creating new products, investing in more plants and machinery, or allocating capital to research and development. The increased future earnings and profits is then reflected in the future increase in dividend payments and share price increases over time. The yield trap. People often focus too much on the current spot yield that an asset provides. Many retirees invest in traditional income investments such as fixed income and term deposits. However, we need to increase our investment time frame to fully appreciate the income generated by an asset. This graph shows the capital value and income streams from an investment of $100,000 in Australian shares compared to term deposits from December 1979 to December 2019. Note the initial starting yield was higher for term deposits. Over the period, the total income in 40 years for the term deposits was $274,225, and the last income payment was $1,250. Whereas the shares returned a total of $1,776,498, with the last income payments at $83,633. The final capital value for fixed-term deposits was still $100,000, compared to $2,055,350 for the shares. The contradiction is that the investment industry classifies term deposits as income investments due to the high yields and stable asset base. Shares are normally classified as growth assets with generally lower yields and a fluctuating share price. However, over the long term, the total income from shares is far superior than the interest in term deposits. Which shares to buy? Peter's strategy focuses on owning productive businesses that pay out a portion of its profits to its shareholders in dividends, and does this through buying diversified funds. Most people just buy a low-cost, diversified index fund or ETF. Peter prefers old-school listed investment companies, known as LICs, that have been around for years and have paid rising dividends over time. Reinvest those dividends to buy more shares. Once you have some shares, every so often, usually each quarter or twice a year, you will receive a cash dividend. You could take this and go and treat yourself, but the best option is to use this money to buy more shares, which in turn increases the amount of future dividends you will receive. Keep buying more shares until your dividend income exceeds your spending. Probably one of the most seductive aspects of dividend investing is the ability to live from your portfolio in perpetuity without the hassle of selling shares, safe withdrawal rates, flexible spending rules, asset allocation, bonds, and sequence of returns risk, etc. Over time, as you continue to add to your portfolio with your savings and reinvest the dividends, that compound interest snowball will begin to build. While it takes time, eventually this income will grow to be larger than your annual spending. It mostly depends on your savings rate, how much you put in and how much you spend. Yes, there will be temporary declines in the stock markets from time to time, and dividends can be reduced every now and then, but the long-term historical trajectory of the markets has always been up. Just take a look at any of the historical charts of an index like the S&P 500. You'll also want to keep some cash on hand to use as a buffer to dip into in times when the markets aren't performing as well. It's also sensible to be a bit more flexible with your spending less in periods of poor performance, but this will probably come natural for anyone who has managed to save large amounts of money into the stock market over their lives. Whilst it is generally widely accepted that a total return drawdown approach will leave you with better returns over time, it probably overlooks the psychological element of investing. For me, choosing how many shares to sell in a period of market turmoil will probably be a difficult thing to do, and focusing entirely on the less volatile income stream of the share market would definitely make it an easier ride. After all, the best portfolio is the one that you can stick to. It's time to retire. Eventually, you'll get to a point where your portfolio will be kicking out enough of that income to cover your lifestyle, and hopefully you have built up a decent cash buffer as well. If dividends fall due to lower company profits from a period of market uncertainty, you can use your cash and spending flexibility to plug the gap comfortably for many years until dividends steadily recover. Listed investment company dividends also tend to be more resilient than the market as a whole, due to their ability to hold a cash reserve to smooth dividend payments over time, which is likely to be a good source of comfort during any poor performing periods. Rent the lifestyle. One of the things that Peter talks about is how he likes to rent the lifestyle. Most people get some wealth and want to own that holiday home, boat and sports car, etc. Whereas Peter typically rents the lifestyle and instead keeps his money invested in productive assets that pay for these depreciating items. Don't be a slave to your money. Investing should be simple and shouldn't consume too much of your time. In the words of Peter Thornhill, do not become a slave to your money, make money your slave. Peter constantly makes the point about not trying to finesse the details too much when investing. Select sensible, suitable, boring share funds with a long track record and then do nothing, and enjoy the rising income generated by the share market. Build an income stream that will grow over time. Couple this with looking after your health, building great human relationships and pursuing passionate projects, and you too will have a successful and fulfilling life.